See, maximum probable loss is nothing but the probability of loss which can happen, like
Okay.
the chances of losses happening. Maximum possible loss is the chance of that severity of the loss. Okay, the chance of that severity of the loss. For example,
Okay.
if there is a loss which like I'm expecting, let's say. So here maximum probable loss is nothing but what is the maximum probability of this loss happening? Let's say there are 40% chances. Maximum possible loss is nothing but if I have to see like if 40% chances that loss is happening, okay. So to
Okay.
what extent that loss can be? To what extent? That means what would be the amount of that? What would be the destruction of that? Correct?
Right.
So, for example, if there is 40% chance that loss can happen, maximum chances of a loss happening, then if that happens, then how much is the possibility of that certain amount of loss? Understood? So, the maximum possible loss is the worst case scenario. It represents the greatest possible loss from a specific risk or event. For example, the maximum possible loss for a building is its destruction and destruction of all its contents. That is the maximum possible loss which you can see from a building's perspective, correct? The maximum
Right.
extent of the loss, the maximum amount of the loss, the maximum damage what can happen. That is what they are speaking about. Assessing risk to financial assets. See, measures of vulnerability to loss can be used. That means how vulnerable a asset is towards a loss, or how that shows the risk like which that asset has or which that asset carries. So measures of vulnerability to loss can be used to assess risk to financial assets and the degree to which value of the financial asset can be affected by external forces. For example, the vulnerability of an investment in common stock. See, common stock is like very risky one. It is the riskiest investment what you do, correct?
Right.
So the vulnerability of an investment in common stock to a decrease in firm sales can be estimated by calculating the firm's leverage ratios. Okay.
Okay.
So, like if you are investing in common stock, what is the formula for leverage ratio? Debt by equity. That's the formula.
Debt by
Financial.
equity.
Yeah.
Right.
So
Huh.
the vulnerability of an investment in common stock, like to an increase in the firm's sales, can be estimated. Like if you are investing in some stocks of a company and you are checking the sales of that company, then you can do that by doing by with the help of leverage ratios. Okay, that means you can see the investment in form of debt finance divided by the equity, and then you can get what is the leverage ratio, and with the help of that you can check whether like how risky the firm is, and then with that also we can know how much revenues we should generate so that we can overcome that risk or overcome the losses which we can incur. Okay, now then a common stock's beta measures the extent to which its value is influenced by factors affecting all security returns. So beta is what? Beta is the measure of systematic risk. Okay, it's the measure of
Okay. Systematic
systematic
risk.
risk. Okay, that means if the market crashes, every firm will suffer. So common stock, if you are looking for the beta of some company, let's say the beta of a company is 1.4, let's say, what does it say? A common stock's beta measures the extent to which its value is influenced by factors affecting all security returns. That means your your securities risk with compared to market risk, which is one. Understood?
Okay.
So we are taking the entire market risk. Let's say it is 100%, and if your company's beta is 1.4, that means your company is 40% more riskier than the entire market. That's what it shows. Now,
Acha.
duration of a debt security. Duration measures sensitivity. How the value of a security is getting affected due to the changes in the interest rates. This is also one of the measures to measure. One of the
Hmm.
measures to measure the sensitivity in the price of a debt security or the value of a debt security. See, what happens? Suppose you took a bond when the interest was 10% in the market. Now it has gone to 12%. So what happens? Your bond price decreases. Correct or wrong? When
Right. Right.
market interest rate
Hmm.
increases, bond price decreases. There is an inverse relationship between these two. So with the changes in this, how this is getting impacted, that is what we are going to see with the help of duration.
Okay.
Just a second, just a second. So for an investment security such as common stock or a debt security, the maximum possible loss is 100% of the invested fund amount invested unless for a debt security a credit default swap has been purchased. See, what does it mean? If you are investing like in stocks or bonds, then the
Okay.
maximum possible loss can be 100%. That means definitely your entire money you have put into some investment. That means you have invested in equity. The loss, if the maximum possible loss is the company goes into losses, you lose your entire money. Second
Mm.
point is if you have invested in bonds, then if the company defaults, your money goes you'll be incurring a huge loss, correct? So
Right.
if like you have taken a credit default swap, that means it's like a credit insurance. If the company defaults, insurance company will pay for that. Then it is something else. You can say that the loss of 100 rupees I have insured that 70% of that. That means if there's a loss of 100 rupees, at least 70 I will get from the insurance company, correct?
Right.
But if there's no insurance, then the loss is to what extent? Maximum possible loss, 100%.
100%.
That's yeah. So same things you can take derivatives also. Derivatives has not been discussed with you, so you may find it somewhat something which you are hearing for the first time. So I am just not covering this in this paragraph. This
Okay.
is a record. I'll take it sometime else. Okay. Now,
Okay.
cost benefit analysis and risk management is also very important. See, for example, if you are to minimize your risk, you are taking certain you are taking some, let's say you're taking some insurance policy. Okay, so you should
Okay.
see what is the cost you are spending for that insurance policy, and you
Okay.
should also ensure that the cost what you are spending and the benefit what you are getting, the benefit should be more than the cost. That's nothing but cost to benefit analysis you are doing. So if the benefit what you get, okay, holistic, that means you should see overall thing, overall benefits from this insurance is kind of something which is like more than, okay, or its
Okay.
weightage is more than the cost, then definitely you can go for this particular way of minimizing your risk, understood, by taking some insurance policy. But if the cost is more than the benefit is less, then it's useless, correct?